The bears finally got their day. A brutal sell-off, leaving many of the bulls offside, and Twitter in an absolute panic after a 1.5% sell-off had the hashtag stock market crash trending. But was today's sell-off profit-taking or foreshadowing of something more sinister happening under the hood? Today, we're going to discuss exactly why we sold off in the afternoon and much, much more. Hello everybody, welcome to the Daily Recap Show. My name is Chase, and we do these videos every single day, giving you the best and most concise recap on stocks and the financial markets. So go ahead, subscribe, like this video. Let's get into it. Just a brutal day in the market. Most of the sell-off coming in the afternoon. Google sat the sell-off out. Semiconductors were the worst performers, absolutely getting demolished out there. And that's because they were probably the best performers over the last week or so. But broad-based selling, indiscriminate selling across all sectors, large, mid, small caps everywhere. And you can see here, semiconductors, the worst performing sector. But the outperformer today was communication services. But all in all, brutal day. And the entire sell-off came after 2:30. In fact, most of these sectors were positive into the afternoon, and it was all 0 DTE. So you see this teal line right here, guys? This is 0 DTE options. This is the rest of the market. And you can see the spread between the two. It's almost identical. And this just means that the sell-off was led by 0 DTEs pretty much. I do believe that the start of the sell-off was probably just people taking off profits before Christmas, and then the algos, the traders all hopped on board, especially as we got below these levels. And the sell-off is completely normal within seasonality. We normally do see a bit of a dip between the 13th, 14th, and 15th trading day of December before we get the Santa Claus rally. Now, this sell-off does actually bode really well for the Grinch parameter. And just to give you guys a recap, the Grinch parameter is the 3 days before Christmas and the 3 days after Christmas, the trading days, the return in those 6 days combined. And if you have a negative Grinch, it normally bodes really well for January and the rest of the year. A negative Grinch has normally seen a positive January 16 out of 19 times, average return 4.3%, and a positive year 18 out of 19 times, average return 19.4%. Now, that is very, very rosy. Nonetheless, you can look at it and expect higher returns if we do get a negative Grinch next year. Let's talk about earnings. FedEx reported earnings yesterday. Micron reported earnings today. The reason why I bring this up is because a lot of people consider FedEx a barometer for global demand, and they were down 11% plus in trade today. That's because they missed on earnings, missed on sales, and their guidance was lower than expected. I've looked into this, and the problem FedEx is having is not a demand issue. It actually has to do with this segment of their business, FedEx Express. They're trying to compete with Amazon. It's a very low margin business, and it's really giving strife for their business as a whole. If you do want to look at what a barometer for global demand should look like, you need to have a look at something like US rail traffic. Rail traffic continues to see improvements. We could see this week compared to 2022, 6.5% increase in total carload, intermodal units 8.6%, and total traffic 7.6%. Now, I know a lot of people are going to say this has to do with the Christmas rush. No, Christmas traffic came in 3 months ago. This is for 2024 demand, and it's far better to look at something like this than what the price of FedEx is doing, because FedEx problems are specific to FedEx. Now, let's talk about Micron, because the CEO had some very, very cool stuff to say about technology, AI, and their earnings was very, very good. They're an unprofitable company, but they beat on EPS, beat on revenue. Operating loss came in less than expected. This is what you want to see from an unprofitable company. And the CEO said this. I want to read it to you. We've seen better than anticipated financial results. We're optimistic about improving business fundamentals and a record industry total addressable market by 2025. Our leading high bandwidth memory technology for AI applications positions us well for growth in AI driven markets. Absolutely crazy. And all he's saying is, thanks to AI, we are seeing growth and we are positioning ourselves well for growth. And I think the AI story is still alive. It's just been forgotten as we go into 2024 because a lot of this buying has been broad-based, indiscriminate. Now let's look at technology as a whole. And the mega cap 8, their valuations are quite pricey, but actually cheaper than it was in 2021, sitting at about a 27 PE compared to the rest of the market, which is at about 19. And if you exclude the mega cap 8, it's sitting at about 17. So if you go ahead and buy the S&P 500, essentially what you're getting is undervalued 493 and a bit pricey mega cap 8. You have to determine if the PE is worth the price, if they're growing, and if the business as a whole is worth it. And looking at fundamentals as a whole, earnings for information technology are expected to grow 16.8%. And let's have a think about this, right? Let's assume 5% auto growth from cash, 3% in buybacks because they're the mega cap 8. You could actually say 4%, and 2% on a weaker dollar. That's just an automatic 10% growth right there, just like given to you based on the economic environment. Then you have a further 6.8%, let's call it 7%, just on productivity and the AI train. In my personal opinion, that should be 7 to 10%. And realistically, when you consider everything I just mentioned, tech's earnings could even be higher in 2024. These are the earnings we're going to use right now, and I actually use about 13%. I always add a margin of safety. We could see the S&P 500 11.8% earnings. I use 8 to 9% when I did my valuation for 2024, my end of year target. And the big story about tech right now is AI. And we could see that McKinsey estimates $4.4 trillion annually, 5% of global GDP that generative AI could produce. And if you have a look up until, I believe, 2030, they're expecting $17 to $25 trillion worth of economic impact in AI. And that would make technology companies 50% of the S&P 500 weight. You have to understand that we are going through labor shortages at the moment, and this is going to continue. There's going to be 3 times the amount of retirees in the next 20 years. And normally tech goes parabolic during labor shortages. And I do think that the tech trade over the next 10, 20, and 30 years is the place you want to be. So what does exposure look like? You can just go get the XLK. If you want something less concentrated, you could actually look at the QQQ, 3 to 5 year estimated growth rate, 13.37%. That's compounded, by the way, and a 28% earnings forward year number 1. I do believe that in 2027, forward earnings are very close to a 12 PE. So just something to note there. And if you want individual holding, look at stuff like Apple, Microsoft, Broadcom, Nvidia, Adobe, Salesforce, AMD, Accenture, Cisco, Intel, okay? Look at these companies, look at their growth rates, look at their balance sheets, and decide what type of risk you want to take. Maybe you buy the fund, maybe you buy the top performers in the fund, maybe you buy the SaaS names, maybe you buy the hardware names, maybe you buy the GPU names. It really depends what you want, what your exposure is, and how much of the business you understand. And here are some undervalued names that you can look at. But let's switch it up. A massive overlooked part of today. Yields fell significantly. I mean, look at the 10-year, below 3.9% on a yield, down 2%. Absolutely crazy. 7 basis point fall in a single day. And look at the 30-year as well, below that 4% handle. And I do think we probably see the 20-year get below that 4% handle. And these shorter duration yields will probably only move significantly once the Fed gets going with these rate cuts. And the market is pricing in 143 basis points worth of cuts. For those of you that want to know how you calculate this, you take this number, subtract it from this number, and then you're going to get like 1.43 multiplied by 100. And that's how many basis point cuts or increases you're going to get in 2024. Now, there is still a bit of stress in the bond market. The 10-year treasury term premium is still negative. This is showing stress in the bond market. The yield curve is still inverted. And this could be saying a lot of stuff, potentially a recession, deflation risk, some form of flight to safety. Maybe people just think the yields are attractive, but there is still the stress in the bond market that I do want you guys to be aware of. The reason why we saw yields fall significantly was on the fact that US consumer confidence jumped to 5-month highs and home sales eked out a gain 0.08% month over month in November. And even though this wasn't reflected in home builders or real estate, these are very good numbers all in all. The tickers right here were affected by the liquidation we saw today more than the actual fundamental. And that's the thing. You have 3 parts of the stock market. You have the macro, you have the technical, and you have the fundamental. All in all, everything will always revert back to the fundamental thesis, dependent on the macro environment, but the flows day to day and the technicals will determine where the stock goes intraday. Now, we're also starting to see American employers are offering record starting wages, just under $80,000. And I'm really happy to see this. It's really good to see Americans finally getting the wage inflation they've needed, because we've seen wage inflation stagnate for the better part of 7 to 8 years as inflation has been rising. And this is really, really great. And this is why we're seeing a tight labor market, a strong, resilient consumer, and increased participation, especially in 55 to 64-year-old males. Now, I do want to preface this. There's always 2 sides to the table, and I'm going to play devil's advocate. If we're seeing 55-year-olds and 64-year-olds enter the market, this is probably because of inflation and increased cost of living. So we do have to always look at the data on both ends and look at the picture and say, what is the data telling us? And then adjust our portfolio accordingly. Now, let's switch lanes from the US and look at the global outlook. So all in all, global GDP forecasts are expected to increase about 2.5%. We can even see increases in 2024 in the Euro area, as well as China, the US too. And this is going to be really, really good for global growth, simply because 40% of S&P 500 earnings come from overseas. So they come from the global area, they come from China, especially Apple, the Euro area, And a weaker dollar and global GDP growth is going to bode really well for US companies. And the EU is starting to get dovish. Implied cuts from the ECB and the BOE, they're starting to get on this dovish tone simply because we're starting to see early signs of deflation in the euro area. Have a look at this. UK CPI 5.1%, the forecast was 5.5%, and we're probably going to see more of this in 2024, followed by dramatic rate cuts. It's why I think bonds are a great investment in 2024. Let's talk about seasonality, and we saw a massive dump into the close today. Very, very rough situation for those that were long up here. Such is the way of the market. We are trending well ahead of seasonality, and we are still significantly positive for the month of December. Now let's have a look at gamma. The call gamma resistance still is at 4,800. We just missed it. We're about 15 to 20 points away from the 4,800 level. And looking at what we did for the day, so this is the 4,800 level. We were slowly trekking up ever so slightly. Dealers were in positive gamma. Then we met this positive gamma zone right here. We rejected off it, and we do know what happens in positive gamma. Dealers sell rips, buy dips, right? So they sold up here, and then we went into this negative gamma situation right here, and then dealers sold into the selling, and that's what happens in negative gamma. Dealers sell into selling. The selling pressure was so much we moved through this positive gamma zone right here into the strong negative gamma zone, and that's why we fell further, and there was some support here at the 4720 level. And you can see right here the 4700 level where we continued to push further into. There's a pretty big positive gamma right here. This is where the negative gamma was forming, and this is why we found support right here and in this area right here. So we went from pretty much the 4800 through here, used this negative gamma positioning as a way to move further down, and then we found support right here. Pretty brutal day in the market, but that's how it works day to day. And here's the S&P 500 now. As long as we stay above this level, I do think that all dips should be met by bull demand. Below here, we could get into some serious negative gamma, and there could be some serious selling, but I do favor further price action to 4,800. It's un-American to not go make new all-time highs in the S&P 500. Bull demand, maybe some consolidation during the Grinch period, and then upward momentum as we hit the Santa Claus rally after Christmas into the new year. Here's some dark pool activity from the SPY. Now, there was some dip buying. We saw the 63rd biggest trade since inception. If we look at it intraday, someone was buying the dip. And if we do move up tomorrow, this is probably a buyer. But if we do go lower, that could be a sign that this could be a short. So there's risks in this market right now, guys. I just want you to be aware. The market brings in volatility. We just have to contend with it. I am still long. We are still long. Hold the line. We're going higher into the end of the year. Let's look at the Santa Claus rally. What does it normally bring? Seasonally, the Santa Claus rally is very, very bullish. Now, in the early 2000s, it wasn't that bullish simply because this was some brutal re-rating, both in multiples, earnings, and tech companies, right? But if you exclude that, whenever we've had a positive Santa Claus rally, it's always coincided with a positive year. When we've had a negative Santa Claus rally, we've had a negative here, right here, right here. Now, let's have a look at when we've had negative Santa rallies, okay? When we've had a negative Santa Claus rally, normally the calendar year is not that positive. You see a negative 1%, negative 10%, negative 30%. This was in 07. So we do want a positive Santa Claus rally and a negative Grinch. If we get both of those, we're going to go to the races in 2024. But let's have a look at some more charts. Equal weight, and you're going to see a common theme in all of these. The equal weight is coming to this support zone right here, working off these overbought conditions, and this is actually really good for higher price action. Things were getting a bit overbought. Let's consolidate, break above, and move higher with the RSP. Exact same thing with the QQQ, working off these overbought conditions. Another day of selling would be really good before we consolidate, move higher after Christmas. So the TLT, this one was very strong. It was up like 1%, between 0.5% and 1% today. I think what we really need to see TLT is come into this 200 DMA, use it as support, work off some of these overbought conditions, and then move higher. Price target for Q1 2024 for the 20-year is 109 in TLT. Looking at the Russell, similar situation, guys, a common theme. These overbought conditions where we're at, this is a good thing. The market's working them off. Just some consolidation and move higher would be ideal. The Russell is at a huge line in the sand. We've always seen selling, so the Russell really needs to consolidate and push above the 200, get into the 202, get into the 205 level and move higher. Otherwise, they are probably going to move a bit lower, probably towards this 200 moving average right there. Looking at Google, very, very strong, was the outperformer today, not even overbought. It's probably going to move higher and it's probably going to outperform for the rest of the week. A good place to put your money in 2024, in my opinion. Looking at Meta, much of the same like Google, not overbought, outperformed today. It was only down like 0.19% compared to the rest of the market, 1% plus. Very, very good. And there is a bit of divergence between here for Meta. Looking at Netflix, after the great earnings, the gap and go, Netflix has been nothing but a runner. It's slightly just coming off overbought conditions. Love to see Netflix to consolidate here because this is a very strong run, like what, 20-30% run in just a couple of weeks. Absolutely insane. Micron, the stock price is back up here, guys. I couldn't get a daily chart in the after hours, but looking very, very strong and probably look for higher price action. We did hear the CEO's comments and probably a great stock to look at in 2024, especially if they do become profitable towards the end of the year next year, 2025. FedEx, absolutely brutal. Support found on the 200 DMA. It is what it is. This is the market you got to deal with. A lot of people are probably trapped up here. I wouldn't personally buy here. There's just some worries that FedEx need to deal with first before I actually look at the stock at buying. Nonetheless, support found here and probably gonna go low. I think we're probably gonna tease below this 200 DMA just for some price discovery, see if the market likes it or not. And here's the dark pool activity. Like I said, a ton of people are stuck at these levels right here. Then we dumped. We found support right here at this 250, 255 level, but we'll have to see what the market does tomorrow and in 2024. Nvidia still consolidated in this range. The market is trying to decide what its earnings are going to look like because it has been beating earnings and it probably will beat earnings, but how much is priced into the stock, it's yet to be seen. That being said, even though we did get into overbought conditions, consolidation in time will work off any overbought level. So if we just consolidate with all of these indices, then we can move higher into 2024 and get that Santa Claus rally. Here's some undervalued names for you guys to look at as well. And here for 2024, guys, just be careful with Baba, but some other ones I didn't mention, Schwab, American Express, ASML. This is a very high quality company, by the way, guys, and they're quite modestly undervalued. So just some names for you guys to look into 2024. Looking at the data ahead, the big one we're looking for is Friday's PCE. That's really what we're waiting for. GDP, personal consumption, core PCE quarter over quarter, but really what we're looking for is this right here on Friday. But if you've made it up until here, guys, thank you so much. Please subscribe to me, leave a like on this video, hit that notification bell, leave a comment. Cheers.